It's Friday, 8th of November, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, did China's leadership deliver on its fiscal stimulus promises? But first, Neil Shearing is back to rake over the coals of another week in macro and markets. Hi there, Neil.
Hi, David.
Have you had a nice week?
Busy week.
Busy week.
Yeah, busy.
Harold Wilson said a week's a long time in politics, but wow, how the narrative has shifted.
Exactly. And if you look at the moves in markets as well, the markets obviously moved a long way as well. So yeah, busy week, but one of those times when at least we can say macro is important, macro is back.
Macro matters. We need that on a t-shirt. To that point, a sea of ink has already been spilled about the US election outcome and what it all means, but it is almost entirely conjectural at this point, isn't it? Are there any certainties now as we stand, or are we in a holding pattern until January to find out exactly what Donald Trump is planning?
I'm afraid there's not much that we do know at this point that we can be certain about. So at the point that we're speaking, we're still waiting on confirmation of the fact that the Republicans have taken the House. That looks likely, but we're not sure what the size of the majority might look like. And we've got confirmation of Trump's pick as his White House chief of staff, but there's still a lot of jockeying going on for positions within the cabinet. So it's still extremely early days. When we rake over what was said on the campaign trail, there's an enormous amount of uncertainty to briefing and counter briefing as to how much of that was hyperbole for the purposes of campaigning versus how much of that's going to work its way into a program for government. So we can be reasonably sure about the broad contours of policy. It's going to likely include higher tariffs, curbs on immigration, potentially some removal of undocumented workers, possibly tax cuts, although we pushed back a bit on that idea. But the magnitude of these policies, the magnitude of these shifts, I think is still extremely uncertain. And so there's not much we can be really clear about. So one important point, I think, is that everyone should be skeptical about firm predictions and forecasts about what next year will bring.
Yeah, don't trust the person who'll tell you exactly what Donald Trump's going to do. All that being said, I think the big takeaway is not that Donald Trump won, but how he won, how conclusively it was in terms of the Electoral College, but also the popular vote. And as you say, this is looking like a Republican clean sweep. In terms of a mandate to get things done, he's looking pretty strong. I was speaking to what you're saying about intentions on immigration, or on tariffs, even on tax. I mean, where are the constraints here?
You're right. I think it's a pretty clear mandate, isn't it? And what's more, it's not just that the Republicans haven't just taken back the presidency under Trump, they've taken back control of the Senate, and it looks like they'll have control of the House too. And of course, there's a majority of conservative judges on the Supreme Court. All three branches of government, it looks like the Republicans have control over. So on the face of it, Trump not only has a mandate to enact his policies, but also the means to do it. It has control over the key parts of government. However, I think that comes with some important caveats. The first is that the majority in the House, if it does materialize, is likely to be pretty narrow. And we've argued that will limit its ability to push through large-scale tax cuts and another package equivalent to that we saw in the first administration, which many now seem to think is coming down the track. I think there's also the point that the economy is in a very different place today than was in the case in 2016, particularly when it comes to fiscal policy. So budget deficit's larger, the federal debt burden is also larger. And so even if Congress doesn't place a constraint on fiscal policy, I think we can be reasonably sure that the bond market will. So we've pushed back a bit on the idea that there's going to be large-scale fiscal expansion. We're baking into what we call working assumptions, the idea that the package of tax cuts in the first Trump administration, which are due to expire next year, we think they'll get extended and rolled over, but we're not factoring in major tax cuts beyond that, other than those that will be funded through things like increased tariff revenues. So no kind of discretionary stimulus, additional stimulus above and beyond it in our forecast. Now it comes to things like tariffs, how much constraint will Congress place on him there? Our sense is that by and large, a lot of what he wants to do could be done through executive action. But the question really is whether or not what he talks about on the campaign trail was really just an opening bargaining position, an opening position, and that will get chipped away at in the course of negotiations. And of course, that's inherently unknowable, but it's something that we're going to have to to wait to see how things play out over the coming months and quarters.
Going back to this question of fiscal policy, though, you've spoken many times on this podcast. You've written a lot about the need for governments to show fiscal rectitude as this debt issue becomes more acute. With 30 years after that, the great bond massacre, I know you referred to in your note a couple of weeks ago, even if we don't get lots of the tax cuts of the scale that Trump has spoken about on the campaign trail, is there a risk that the bond vigilantes will assert themselves regardless? We have seen that move up in yields straight after news of Trump's victory started filtering in. So could we see more assertive pushback in the bond market as we go into 2025? What is the risk that we do have this showdown between the Trump administration and the bond market?
Well, look, the first thing to say is I don't believe that the threat of bond vigilantes is necessarily going to be a major constraint on Trump attempting to do something. I wouldn't like to be the economic advisor walking into the Oval Office and saying, Mr. Trump, you can't cut taxes because of the bond market. I think you get short shrift back. So it might not stop him trying, but then you get the response in bond markets. And I suspect at that point, we'd have a moment where politicians had to walk things back and cool things down. So I think it's going to be a pretty rocky ride if Trump and his administration is intent on pushing through tax cuts. You could get major sell-off in the bond market and then a recovery, a bit like we had here in the UK, actually, after the trust debacle, where the government then walks things back and tightens policy, or at least walks back promises of additional stimulus. So I think it's a rocky ride. Now, over the course of the next month or so, I think what really matters is the tone of communications from not just Trump, but Trump officials, and also who are the key members of his cabinet, in particular, the Treasury Secretary. I think if they're relatively sensible appointments, and there's already noises coming out of key members of Congress about the need for some fiscal restraints and guardrails, then I think actually we'll end up with a situation where yields are a bit higher. So we've pushed up our forecast for the 10-year Treasury to 450 by the end of next year. But that really reflects a higher part of Fed funds rather than acute fiscal risks. That's on the basis that really there isn't a major fiscal stimulus and the Trump administration does adhere to some semblance of fiscal discipline. However, as I say, if it doesn't, and it is intent on pushing through another major package of tax cuts, then things could get messy quite quickly, I think, in the bond market.
Could get more complicating for the Fed as well. That's my segue to ask about the meeting that we had on Thursday, the latest decision, but also just looking more broadly at how the Fed sets policy now that the outlook seems to have changed so dramatically in terms of where bond yields are going, in terms of the Trump policy package. Has Jerome Powell's job got that much more complicated over the past few days?
I think it's got enormously more complicated, yes, partly because the economic outlook has become more uncertain. There's uncertainty around fiscal policy, that's the major uncertainty, but also what happens to tariffs and the impact that might have on inflation, what might happen to immigration, the removal of undocumented migrants and the impact that would have on labor supply and therefore the economy's potential growth rate and possibly inflation too. So there's uncertainty every which way the Fed looks. And laid on top of that, there's this sense that the Fed might come under pressure from a Trump administration to keep interest rates low, even if it were to push through or try to push through fiscal expansion. So there's the politics of the situation, the small p politics of the situation as well. So yes, Powell's position has got enormously more complicated, I think. Now, insofar as how that's managed, he was pretty clear that he's not going anywhere before the end of his term, and he doesn't believe he can be fired either. But there's ways that Trump could make life more difficult for Powell if he wanted to. There's rumors swirling that he might nominate Powell's successor. Powell's term's up in 2026. He could nominate his successor early, and we could end up in a situation where we could have a shadow Fed governor for a time. That would make things extremely difficult. I don't know how likely that is, but it would make things much, much more difficult for Powell. And then as regards the actual policies themselves, Powell's position is explicitly, he said in his press conference, we don't guess, we don't speculate, we don't assume, that they're going to wait to see what these policies are before they react to them. But of course, that means they're necessarily going to be a bit behind the curve. So yes, life for Powell is about to get enormously more complicated, I think.
There were echoes with what Powell said and what Andrew Bailey had said earlier when he got the question about the impact of Trump's election at the press conference after that Bank of England decision. So talk about what Trump's election victory means in terms of global monetary policy making.
Yes, I mean, you can be sure that the governor of every major central bank over the next month or so is going to be asked in press conference, what does a Trump administration mean for monetary policy in insert country A, B, or C? And you can be equally sure that they will say, we don't pre-commit, we'll wait to see what policies are announced, and they'll shrug the question off. And I think largely the implications for policy in major advanced economies will be pretty limited. That's not necessarily true of some emerging market central banks, by the way, particularly the Central Bank of Mexico, where we think the scope for monetary loosening now is a bit more limited, given moves in the exchange rate, weaker peso, stronger dollar. But by and large, for the major advanced economies, I think the implication for monetary policy from a second Trump administration is pretty limited.
We say it's limited. Talk a bit about why we expect it to be limited, given what Trump's saying about global trade.
Look, of course, there are, circumstances in which it may not be limited. There could be profound effects if the world was to descend into a global trade war precipitated by heavy tariffs being imposed by the US, then that would have major implications for monetary policy. However, our working assumption is that tariffs will be raised, they'll be increased, but they won't be increased quite to the extent that some of the more extreme statements made on the campaign trails, 2,000% tariffs on imports from Mexico, for example. There'll be some negotiations, there'll be some carve-outs, things will get dialed back a bit. Now, if there's a 10% universal tariff on all US imports, including those, say, from the Eurozone, we estimate that would knock about 0.1% off of Eurozone GDP. So that becomes a rounding error in GDP forecasts. And there's enormous uncertainty too as to the timing of any such move. So not only do things like tariffs are not going to have a big impact, I don't think, on global trade over the next 12 months or so, or GDP, for example, in the major advanced economies, the timing is uncertain, unlikely to be very immediate. This is not going to happen in the first week or so of a Trump administration. Hence, I think if you're thinking about interest rates over the next 12 months, when it comes to the UK or Eurozone, for example, I think the implications are pretty limited at this stage. As I say, you can create alternative scenarios where they're not, but where the consequences are substantial. But at the moment, they're best viewed as a low probability, high impact event rather than something approaching a central scenario.
Neil Shearing there on a momentous election result and what Trump means for global macro and markets. Our dedicated Trump page is where to go for all of the key insight on what this all means, and we've got a growing body of analysis covering all regions of the global economy and markets, from commodities to financial to commercial property. We are laser focused on the implications of the coming administration, but the regular data is still coming, and we'll continue to watch that and give you timely analysis that you can use. In the coming week, we've got UK labour data. There's also GDP growth numbers for the UK and Japan. And at the end of the week, we're going to get the October investment, retail sales and industrial output numbers for China. All eyes were on Beijing on Friday for the outcome of the National People's Congress Standing Committee meeting. It's fair to say that no standing committee meeting has been as closely watched by global investors, but that's what happens when a string of stimulus announcements over several weeks manage to disappoint. For many, this week-long meeting was expected to be the moment when the leadership would finally announce the details of its plans to loosen fiscal policy and give the economy a boost. And did they? I spoke to Mark Williams, our Chief Asia Economist, soon after the wrap-up press conference to find out what was decided. Here's Mark now on the big reveal.
But it wasn't that big, actually. And there's so much anticipation ahead of this event. And in the event, what we got was a debt swap program, which is worth about 10 trillion renminbi over the course of the next few years. And that is to be used to allow local governments to bring some off-balance sheet debt onto their balance sheets. So essentially, the government is allowing them to issue government debt at a lower interest rate than their existing off-budget debt. So they save a little bit of money. We get a little bit more clarity about the level of government debt. But that's it. There had been all this speculation about big packages of spending going into different ways. And some of the numbers that have been thrown around, they've just been escalating over the past few weeks. We've been talking about 3 trillion, about 10 trillion, seen bigger numbers than 10 recently as well. But when it's come down to it, what we've got is this debt swap program. This 10 trillion number does not mean 10 trillion of spending in the economy. It's just swapping debt. The only way really in which this boosts demand in the economy is that this new debt is going to be cheaper than the old debt for local governments. But the finance minister himself on Friday said that will save them about 0.5% of GDP spread over 5 years, that lower interest rate. So it really doesn't amount to very much at all. And it's not going to make any appreciable difference to the economy in terms of growth anyway.
So the stimulus that wasn't, but it is coming after a whole barrage, a bazooka, a blitz, whatever the language was in the headlines of stimulus measures. So taken together, will all of this in totality make any difference in changing the outlook for China's economy?
No, and I don't think that it's right to talk about it as a barrage. Certainly that's the way it has been talked about, and these kind of barrage, bazooka, big fiscal packages have been talked about a lot. But I do think that to an extent, a lot of commentators on this topic have been convincing each other that there's quite a lot coming. Whereas if you go actually to the announcements that have been made, I think it's both the case that the announcements are quite a lot smaller than a lot of people have suggested, and also that the statements that the leadership have made didn't really give us reason to expect there to be a huge amount. So if we go back to late September, when all of this speculation about a stimulus package began, it kicked off with the People's Bank announcing a package of measures. That was significant in the sense that there was a number of measures all announced together. But you look at what those measures were, they were things like a 20 basis point cut to the main policy rate. Most economies, a 20 basis point cut to a policy rate is a disappointment. It's lower than the typical interest rate move. So it really wasn't that much. They also lowered down payment requirements for second homes. There was a load of these kinds of measures, but individually, they didn't amount to much. And collectively, to be honest, I don't think they amounted that much either. And a few days later, the Politburo comes out and signals that it's become a bit more concerned about the economic outlook and calls for more policy support. That's what then got people thinking, wow, there's going to be something more. There's going to be something more from the finance ministry to back up what's come from the People's Bank. But look at what the Politburo actually said. They talked about this need to, as they put it, intensify countercyclical adjustment. That is not a sort of whatever it takes statement that they're going to do anything to boost the economy. And in the week since then, the finance minister has also come out. He was out on Friday, but he was out about a month ago as well in a press conference, also saying we'll do more to support the economy. But I think there's been a lot of overinterpretation of what that means. I think the finance ministry does think it is doing more. So, for example, perhaps the most meaningful thing that it's announced over the past few weeks is it's said that there's all this money that is in this year's budget which hasn't been spent, worth about 1.6% of GDP when they mentioned it in the middle of October, and that will be spent by the end of the year. Now, that's not nothing. 1.6% of GDP spread over a few weeks is going to give a bit of a boost. But I don't think people were right to be expecting a significant package. And so far, given what's just happened on Friday after this National People's Congress Standing Committee meeting, I think that's where we are.
So a misreading of government's intent to support the economy. Lots of big numbers have been bandied around over the past few weeks. Does this press conference we've just had on Friday, does that mark the end of this speculation about big fiscal stimulus packages coming in to save the economy?
I think that people have been knocked back perhaps enough times now that they're going to give up. Certainly, I think we might still have a few more announcements. The finance minister did say, for example, that there's going to be another increase in special bonds to help with the bank recapitalization. No more details about that, but he did say that on Friday. He also said that there are measures being considered to help the property sector, and specifically said to buy land and to buy finished properties from developers. If that is announced and there's a big enough price tag attached to it, that could make a difference as well. But right now, I don't think that we should continue to expect this sort of thing that we got in 2008, which I think is what has framed a lot of expectations for what you can get from the finance minister in China. We're not going to get one of those sort of big comprehensive packages, which are all about boosting demand. Instead, it's things like this property scheme, which is specifically about trying to deal with the problems in the property sector, or it's a bank bailout, which is specifically about another structural problem.
And all that being said, actually, the recent data suggests that things are getting a bit better, aren't they? We've got October retail sales, fixed asset investment, and industrial production numbers in the coming week. Do you think those are going to confirm that the economy is turning a corner?
Yes, I do think that there's signs of momentum across the economy at the moment in terms of domestic demand. The data that we've already had for September was strong pretty much across the board, really. Our own China activity proxy certainly points to a pretty economy-wide pickup in momentum in September. And the early data for October are similar. And I think that is perhaps linked to this push by the government to make sure that the budget is fully spent this year. And again, that also then links to a big reason why the government seems to differ from a lot of commentators in the view that perhaps the economy doesn't really need a huge stimulus right now because it's already picking up a bit of steam.
Before I let you go, I have to ask, talking about the speculation around Chinese stimulus or the stimulus that wasn't really, a lot of it was going on at the same time as we're in the final few weeks/days of the US election campaign. There was some talk about how the Chinese government was waiting to see if Trump won, and if Trump won, then there could be more stimulus because they're going to counter the impact of the tariffs that they're expecting the Trump administration to bring in. First of all, what do you make of all of that? Second of all, how do you think the Chinese government is preparing for the second Trump administration?
In terms of the announcement on Friday, I heard ahead of the US election an idea that partly this meeting had been delayed so that it would conclude after the election, so that if Donald Trump won, they could announce a big fiscal package. And then when Donald Trump won and there was no big fiscal package, I heard that was deliberately because the government wants to keep its powder dry, wants to hold something in reserve. Essentially, it's all about the US, whatever happens. I really don't think that's what's been going on. I really don't think that this is linked at all to the US election. Having said that, clearly minds in Beijing will be working very hard at the moment to think about what China's options are for the 4 years of Donald Trump's presidency. Obviously, there's the experience of last time around, and they've had plenty of time to plan, I think, what they will do. I don't think it's made a difference to fiscal policy this time, but I would expect that there are various plans being drawn up to think about how to respond in terms of whether to put tariffs on the US, what they can do to perhaps drive a wedge between a more isolationist US and the rest of the world, how they should treat companies like Apple in China, who really did not get touched during the trade war in Trump's first stint in power. And of course, this time around, Tesla as well. How are the Chinese going to treat Tesla, which has these huge operations in China? So I'm sure there's a lot of planning, a lot of thinking going on, but I just don't think that fed into the fiscal decision.
That was Mark Williams on China and Trump and the Chinese government's plans to bail out local governments but not do much to boost the economy. We've got a whole body of analysis on where China's economy is heading in the coming years. At the heart of this is a long-standing view that economic growth is likely to slow to around 2% by the end of this decade. That used to be one of the most bearish views in the market, but the consensus is slowly coming round. On China and Trump, there's new analysis on the 3 Ts, that's tariffs, tech, and Taiwan, and that note can be found on our dedicated Trump page. But that's it for this week. We will be back next week with more of what's hot in global macro and markets. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.